Okay, class, picking up where we left off at, we were at 8,400 shares, and that was the final answer to problem 14. Now we turn to page 272 for problem 15. It says, our clever friend, the Apple investor, could have sold her shares for $130.28 on June 1st, 2015. If she had done so using a brokerage with a 1.5% commission, what would her profit have been? Remember, profit is the difference between cost and final proceeds from the sale, which would be selling price minus commission. Needless to say, you should show your work. Okay, first of all, our friend had 8,400 shares with all the stock splits. It cost our friend $7,888.68, and that was the total cost to buy. Now, if we take this 8,400 shares and multiply it by $130.28, which is the amount that she sold the shares at, that would give our friend $1,094,352, which was the selling price. Now, we would take this $1,094,352 and we would multiply it by the 1.5% commission. And that would be $16,415.28. And that would be the commission. Now, we would take this $1,094,352 minus the commission, which is $16,415.28, and that would give us $1,077,936.72, which is the proceeds. Now we're almost done. The last thing we need to do is find out what the profit is. Now, this was the proceeds from the sales and the commission coming out. But to find out what the actual profit was, we would have to take this amount and subtract how much our total cost was. So then we would subtract $7,888.68 from the $1,077,936.72, and that would give us a profit of $1,070,048.04, and that would be our profit. Now, number 16. How much money would our investor have saved by using an online trading site with a flat commission of $19.95 per trade for both the original purchase and the sale? Okay. The commission on purchase would have been $154.68. This is how much it was, the original amount. And then the commission on the sale, as we stated here back in problem 15, was $16,415.28. The total commission, using the broker from the earlier examples, was $16,569.96. Now, if they would have used the flat rate from online, we would have did $19.95, and we had two transactions. The one transaction a buy, one transaction a sell, and that would have cost us $39.90. So to find out how much would have been saved on commission, we would take the $16,569.96 and subtract the $39.90, and that would have given us a total savings of $16,569 $530.06, which would have been saved. And that is the final answer. Okay, now we go over to page 273. And it says we have the price to earning ratio for a stock. The price to earnings ratio, commonly known as P/E ratio, is a key indicator of how reasonable the current price of a stock is. It compares the selling price of the stock to the annual amount of money the company has earned per share. If the PE ratio for a certain stock is 20, that means that the current selling price is 20 times as high as the earnings per share. This tells us that for every dollar you invest in a company, that company will earn a nickel. Price over earnings ratio can be a little tricky to interpret. On the one hand, a lower price over earnings ratio indicates that a stock is priced reasonably, as you need to invest less for the company to make a certain amount of profit. But if investors believe in the growth potential of a company, they may be willing to pay a premium for the stock, which will result in a higher price over earnings ratio. To help get some perspective on price over earnings ratio, it's useful to do some calculations. First, a formal definition. The price over earnings ratio is here, which is the current market price, divided by the annual earnings per share. So now, this is another thing you should have on your note sheet. Number one, it says for the Facebook stock table from earlier in the lesson, calculate the price over earnings ratio using the current price and earnings per share compared to the price over earnings ratio listed in the table. Why do you think they're identical? Okay, what I did here, I put the Facebook stock right here, but I'm going to have to remove it after a while. But if we look here, the price over earnings ratio is the current market price over annual earnings per share. So now, what we're going to do the price over earnings ratio, which is the current market price all over the annual earnings per share. So the current market price is $87.27 according to what we have on page 270. Now we want to see the earnings per share. The EPS is 0.98. Now when we put that in our calculator, it will give us 89.05. So now, if we look here, the table says that it's 88.69. Okay, so now the table says 88.69, and this could be a rounding error. Or maybe the price has fluctuated. And the price over earnings ratio hasn't been updated. Okay, now we come here to problem number 2. Not every stock table you will encounter has quite the wealth of information that the ones at the beginning of this lesson have. A more abbreviated table might have the price over earnings ratio but not earnings per share listed, in which case you can rearrange the above formula to calculate earnings per share. On September 8, 2015, Google stock closed at $600.70, and the price over earnings ratio was listed as 28.31. What was Google's earning per share for the previous year? How does it compare to Facebook? Which do you think was the better investment at this point? So now, basically what we have is this here. It'll be the $28.31, because that is, we were told that that's the price over earnings ratio. So this is our P/E ratio. Now, we know that we would do our current market price. They told us that the current market price was $600.70. Now, it's supposed to be over the annual earnings per share, which is X here. Now, so this is what we do. Let's refer back up here. Current market price over annual earnings per share, which we have here. Now what we need to do, we're going to solve for X. So the first thing we should do is multiply each side of this equation by X. So now, this will give us 2831X is equal to, these X's will simplify out. It'll be 600.70. We'll divide each side by 28.31. And when you put this in your calculator, X will be approximately $21.22. Now, this is much higher than Facebook. So Google is probably the better investment. Though it costs more. Okay, now we'll go on to page 274. Now we look here. The table below summarizes some basic rules of thumb when it comes to interpret the price over earnings ratio for a stock. Remember that the best approach is to compare a stock's price over earnings ratio to other companies in the same industry, as current market conditions can have a pretty profound effect on price over earnings ratio. Now we have the common interpretations. N/A company has no earnings is also standard for a company with a negative earnings, that is a loss, to have an undefined price over earnings ratio, even though mathematically a negative price over earnings ratio does make sense. Yeah, it may make sense mathematically, but when you're trying to get people to invest in your company, it wouldn't be a good show to show that you had a loss. Okay, 0 to 10. The stock may be undervalued, making it a good buy. Alternatively, investors might feel like the earnings are likely to decline. The company may have shown short-term profit from selling assets that will hurt earnings in the long term. 10 to 17. Price over earnings ratio in this range are historically considered to represent stocks being sold at fair market value. 17 to 25. The stock may be overvalued, so shop carefully. On the other hand, earnings may have increased since the last official earnings report was released. The company might be up and coming, with earnings expected to increase dramatically at some point. And then now we have greater than 25. The stock might be very overpriced at the moment, or the company may be expected to have a big jump in earnings coming up. It could also be the case that the company's most recent earnings are unusually low for that company, with an expectation of recovery. Okay, come up with some ideas why the Facebook price over earnings ratio might have been sky high in September of 2015. You might want to look up the history of Facebook stock on the internet. Okay, first of all, many people feel it was overpriced at that time because it had just gone public, offering stock. And had such a big name, people were overly excited about it. So basically what this is saying is because Facebook was offering stock and people already knew it, people got very excited about the stock and end up paying more for it than possibly they should have. Okay, now we go on to the next page. Now we come here to investing in bonds. When an investor buys bonds, the investor is actually loaning money to the company or government entity that issues the bonds. In exchange for lending that money, the investor will receive a fixed return on his or her investment for a given period of time. The ending value of the bond is called the face value. This is typically $1,000 but can vary. Bonds also have a maturity date, which is the date that the face value is returned to the investor, as well as interest. In some cases, no interest is paid until the maturity date, at which time the full amount of interest is paid. Coupon bonds, on the other hand, pay an annual or semi-annual interest payment, known as a coupon. You can think of it this way. If someone offers to sell you a $20 bill for $15, that's a pretty darn good deal. But the catch is that you don't get the $20 until some predetermined time later down the road. That's what a bond is. It's actually pretty simple. But here's where it can get more interesting. Suppose that you get tired of waiting for the time when you get that $20 bill and you sell the bond to your neighbor for $18. You've made $3 on your investment and you're done. Your neighbor now waits until the maturity date, cashes in the bond, and made the other $2 of the original $5 in profit. This is how bonds are bought and sold on the open market. Of course, your neighbor wouldn't pay more than $20 for a bond with a maturity value of $20. But if you were desperate for cash, you might be compelled to unload the bond for less than the $15 you originally paid. You've taken a loss, but at least you got some money out at the time you needed it. Investors buy bonds for two main reasons. First, they're much safer investments than stock, even though they have much less opportunity for a big profit. The interest is guaranteed as long as the company that issued the bond stays in business and has the money to pay its debts. This makes bonds a safe but not guaranteed investment. Second, bonds are used to offset losses on stocks when the economy is in a down cycle, because the value of bonds tends to go up when the value of stocks goes down. Here's a short version of why that makes sense. In our early hypothetical example, where you're making a $5 profit for waiting to cash in your bond, if the economy is booming in the meantime, prices in general will tend to go up. So the $5 you're waiting to cash for so basically I lost my place. So the $5 you're getting at some point in the future has less buying power than the $5 you were expecting when you made the investment. This makes the bond in effect worth less. The opposite is also true. If the economy fizzles after you buy that bond, the $5 you eventually get will in effect be worth more than the $5 you thought you were getting. So the bond is worth more. Stocks tend to rise when the economy is doing well and fall when it's not. So the value of bonds usually goes in the opposite direction of the stock market. Suppose that you buy a bond with face value $1,000 that was originally issued 18 months ago. The maturity date is 4 years from the time it was issued, and the interest rate is 4% simple interest per year. If you pay $820 for the bond and keep it until the maturity date, what is your profit? What percent return would you get per year? Let's do some calculating. It says, find the amount of interest that will be paid on the bond at maturity and the total amount of money you'll get from the issuer at that point. You'll want to reach back into the archives and use the simple interest formula. Okay, so we had interest is equal to principal times rate times time. The principal here is $1,000. That's how much the bond is worth. And then also, the initial cost of the bond is $1,000. So that's the principal. And then the rate is 4%. And then also, it's over a 4-year time period. So when we multiply this out, this will give us $160 in interest. Now, we would take that $1,000 that was initially invested plus the $160, and that would give us $1,160, which is the total received. Now, we will move on to problem number 5. It says, find the profit you make on this transaction. Okay, so when a bond is cashed in, it's worth $1,160. You paid $820 for it. So you made $340 in profit. Now we come down here to number 6. What percent of your investment is the profit made? So basically, you made $340 off of an investment of $820. So when you divide this out, it'll give you 41.5%. Now your calculator, of course, is going to be 0.415, but we will convert this to a percent of 41.5%. Now number 7, if you divide your total percent return from question 6 by the amount of time in years that you hold the bond, you'll get your percent return per year, or annual return, which is a key indicator of how well an investment performs. A long-standing rule of thumb on long-term investments in the stock market is that you can expect annual returns in the 6 to 7% range. How would this bond investment compare? Okay. You have 41.5% divided by, you held on to the bond for 2.5 years. Because remember, you bought it at 18 months, which was 1.5 year, and then you cashed it in at the 4th year. So looking at that, it's a 4-year bond. You bought it at 1.5 years, which leaves you 2.5 years left. That's how we got the 2.5 years. So that would equal to 16.6% per year. And this is an excellent investment. Okay, now we're done.